Just like to talk for a moment about what it is we're trying to achieve with version 2.0 of Fibonacci Swing Trader, besides the obvious, which, as I mentioned a moment ago, is to reflect all of the updates and refinements that have been implemented since October of last year. In a nutshell, what we're trying to do here is show you a powerful, effective, and easy to understand method for trading Forex, or in fact any liquid market, which might include stocks, stock indices, commodities, etc., and to show you how you can scale that methodology up or down as needed from the default swing trading style. So we're going to focus on swing trading, true to our name, but what we're also going to address is the fact that from time to time you may wish to scale this methodology in the upwards direction to take advantage of some of those juicy position trade setups that come along from time to time. Or conversely, when the market is not trending with sufficient clarity, we might want to go in the other direction, scale it down to more of a day trading or scalping approach. All of those are possibilities with Fibonacci Swing Trader. If you choose to make this methodology your own, that's great, but I'll just offer the opinion here that whether it's this trading system or something else, it should be scalable. I think that's the hallmark of an effective trading style. Any methodology that can only be used on one time frame or to suit one trading style, I don't think is as robust as it needs to be. So always make sure that whatever you're working with can be scaled up or down as needed. In addition, we're going to cover all aspects of managing a trade, from first identifying it through to closing the trade. So that includes things like identifying the tradable bias. We never take counter trend trades with this methodology unless they're really, really big counter trend moves, a correction, let's say on a daily chart or a weekly chart. Okay, but where we define the trend, we're trying to trade in that direction, in the path of least resistance. With that established, we then use Fibonacci retracements with swing points and support resistance confluences to set up the trade. We have a special but very simple tool for validating the setup, as well as giving us a very clear and mechanical entry trigger. We'll go over exit targets and trade management. All of those bases will be covered in spades by the time this version 2.0 course is done. In case you're new to swing trading, let's begin by defining the term. In version 1, we had a more detailed definition. I think we can summarize things simply thus. Swing trading, per this methodology, means using a set of consistent momentum readings, either bullish or bearish, across each of the weekly, daily, and 4-hour charts concurrently as a springboard into a Fibonacci retracement setup found on either of the 4-hour or 60-minute charts. Now, just a caveat there, if the market is already moving and you missed that first and best entry point on, let's say, an hourly chart, you may need to drill down further to your 15-minute chart. In fact, it's not inconceivable that you could actually use a 5-minute chart. So there are other options, but for the size of run that we're looking for in terms of a swing trade setup, we're really going to be spending most of our time on the 4-hour and 1-hour charts for the setup. Again, you can drill down even lower to execute. So our default position is to look for an hourly bar entry trigger that will get us into a trade which offers a bare minimum of 60 pips profit potential with a risk of no more than 30 pips using limit exits that may remain open for 24 hours or longer. In reality, we can never pinpoint how long the trade is going to take. Sometimes the markets move really quickly, and what we thought was a swing trade actually ends up taking just a few hours, so it's more like a day trade in terms of time to complete. Conversely, sometimes we'll wait for several days. It's just hard to predict ahead of time which of those scenarios is going to pan out. So these are just sort of general benchmarks, but you will see some variety in terms of profit potential. Again, anything under 60 pips we're not going to touch as a swing trade. There's nothing to say you might not look at that if you're scaling down the methodology looking for a day trade or a scalp. But a swing trade should provide at least 60 pips. Again, that's the bare minimum. We're typically looking for something more in the neighborhood of 100 to 200, maybe 300 pips from time to time if we get lucky. But we're still looking for reward to risk performance of 2 to 1 or better. In case you're wondering how it is that version 2.0 differs from version 1, those differences will probably become apparent by the time we're done through the various trade examples and chart illustrations we'll refer to. But in the meantime, I thought I would highlight the major updates. In version 1, we specified a paired moving average system, the 10 and 20 period exponential moving averages on the daily chart, looking for gap and angle readings to convey the tradable trend. And there's nothing wrong with that. We're not saying, oh, we've changed our mind, we don't think it works, this, that, or the other. It's still an effective longer-term trend indicator. But what it doesn't do is reflect intraday trend readings or momentum. And so what we've tried to do really is close the gap on that and bring our trend or momentum monitoring system into closer alignment with the top-down philosophy of trading. And to do that, we've implemented the triple screen concept, which is inspired by the work of Dr. Alexander Elder. He uses an indicator called the force index on multiple time frames. We're not using the force index. We did for a little while in our daily update service. It's a very handy indicator for sure. But the problem is it's based on tick volume, which not all members have access to in their respective charting platforms. So we opted to refine that methodology by substituting a stochastics 933 reading in place of the force index. But it's still true to the concept. And so instead of just one trend indicator on one time frame, i.e. the daily chart, which we used originally, we're now looking at groupings of 3 consecutive time frames, getting the green lights, whether bullish or bearish, I guess it would be green lights or red lights, to look for a setup in the direction of trend or momentum. The momentum matrix is just a thought piece that helps you make sense of lining up 3 time frames across different groupings of time frames. So for swing trading, it's weekly, daily, 4-hour chart. For position trading, it's monthly, weekly, daily. For day trading, it's daily, 4-hour, 1-hour. For scalping, it's 4-hour, 1-hour, and 15-minute. We'll go over all those groupings in greater detail later on. In the original course, we were looking for so-called overbought, oversold signals to help us find the end of a retracement, the end of a dip in the uptrend or rally in the downtrend. We have dropped those signals. The triple screen concept allows us to do that, quite frankly. We don't need to interpret stochastics in that fashion. And the reality is, it's hit or miss to find a truly overbought or oversold reading. Sometimes the market will rally sharply, and what stochastics will do is go into an overbought scenario, or what looks like that, only to stay there for a very long time. So if you're trying to read overbought as a market top or oversold as a market bottom, again, it's hit and miss, and that's just the fact of life. But the triple screen concept saves us from having to do that. We have simplified the stochastics layout. It's just a dead simple system now. We're not even looking at the percent D line, just percent K, and we're looking at it in relation to a single level of 50% on the indicator panel, which represents the boundary between bullish and bearish momentum. We'll go over all of that in detail later as well. We have simplified and at the same time made more mechanical and precise our rules for trade entry. We have refined our reward to risk guidelines, and we have also included the 60-minute chart for setups and entries. That wasn't a part of the chart lineup originally. In addition, we have introduced new formats for the daily update report for subscribers to that service, as well as our performance tracking database. There are other detailed elements that have changed over time, but that list is pretty comprehensive. And as I say, through the different examples we'll go through in each of the different modules, they'll become more apparent. Just like to take a break from all the PowerPoint slides for a moment and switch into chart mode and just demonstrate quickly one of the major changes in the methodology that we just addressed in the previous slide. I'm showing you here a daily chart for the Aussie dollar pair. In version 1, we talked about a paired 1020 EMA. We've got that reflected here with the solid red line being the 20 period EMA and the dashed lighter line being the 10 EMA. And what we were looking for is a stack effect. And so I'm just going to generically show you what that might look like. Okay, it's the wrong color scheme here. It should be green when it's rising, but you get the idea. So we were looking for, first of all, crossovers at the bottom when the 10 EMA crossed above the 20 and both rose in tandem, price preferably remaining above both lines. And so we got a pretty good example of that here on the Aussie dollar pair from about after the crossover here. Well, take your pick. It's either March 25th or 28th, depending on how conservatively you want to read this thing. But from there, price was around about the 10250 mark. And we got this bullish gap and angle reading. Again, it should be color-coded green, not red. But it carried through with accuracy right up to, I would say, certainly not much later than the close right here of the close of May 4th at 10734. So that's about 500 pips of upwards movement. And you could have either tried to position trade some portion of that move or grab hopefully numerous swing trades or day trades on the way up. And so that was all well and good. But then our methodology says when the two moving averages start to converge upon one another, which you could also see by way of MACD behavior, obviously, since that's simply the difference of two moving averages, then it becomes a little bit shall we say, kludgy. It's a little bit hard to read. We don't have a clear gap and angle reading, just two moving averages converging on one another. Now there's two possibilities as to what's going on. One could be that we're looking simply at what Ellioticians might refer to as a zigzag correction of some kind before the market regroups and heads higher. I don't know if I would put strong odds on that just at this point, but regardless, that's one option. The other option is that this really is a top here for May 2nd, and what we're looking at now is a first wave down, retracement to a lower high against it, and as I record this, we're just waiting for the market to give us a fractal downtrend continuation like so. Okay, but right now the 1020 moving averages are not tipping us off either way. It's not gap and angle, which means that from a trend reading perspective, we wouldn't likely do anything with this. But what I've got plotted below here is our simplified stochastics layout, one of three which we would reference in a triple screen. Now, the weekly momentum might still be bullish, which means we don't have a triple screen on the short side. The daily chart since the close for, let's say, not May 4th, this is the close of May 5th, we had a crossover here, stochastic coming through the 50 line. Okay, again, that was confirmable on the close for this day. So that's just telling us that if we were to start scaling down, starting with the daily chart as the highest time frame, we will look at the daily 4-hour and 1-hour charts. And if we could find a situation where they were all lining up together in a bearish stance, then we would look for shorter term short trades. So what the triple screen can do for us is give us opportunities while we're waiting for this slower lagging 1020 EMA system to either give us a crossover and bearish angle and separation that way, or give us a crossover bullish gap and angle that way. Okay, right now the market is not really made up its mind fully just yet as we record this. But whereas the old trend monitoring system would have us therefore sort of sit on our hands, so to speak, there's still action to be taken using more of a top-down momentum reading approach based on the triple screen concept. And I won't explain the triple screen here, we'll get into that later, but I just wanted to illustrate one way that we've tried to improve our reading of the market. We've done away with 10/20 EMAs, although when they're giving you gap and angle, you can still use them. We're just not featuring them now, and instead using a stochastics-based momentum indicator. I'd like to now just give you a quick table of contents summary of the different modules in version 2.0. You're, of course, in the introductory module now, which tries to explain in brief what it's all about, let you know what's coming next, which includes Module 2, called Chart Layout, Tools, Indicators, and Annotations Used. Hopefully that's self-explanatory. We're just putting the entire toolbox together for you to show you how to organize the information to trade this methodology. Next up, Module 3 introduces the triple screen concept, which is both a scanning tool and an entry trigger. And we'll explain exactly how it does both of those things in greater detail, of course. In Module 4, we'll show you how to draw retracement coordinates using swing points in conjunction with Fibonacci confluences, support or resistance, as appropriate. In Module 5, which is entitled Rules, 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 we'll talk about exactly that, all of the rules which govern how to enter and exit a Fibonacci swing trade smartly. Module 6 is completely new to this version, difficult setups. Now, it's just a fact of life that the market will look like it's going to do something we expect, and then it just goes sideways on us. And what we'll talk about is the different pitfalls to swing trading. You need to know about these. There's no system in the world that can guarantee you a smooth, bump-free ride every single time. And so what we want to do here is address the types of situations and scenarios you might encounter from time to time, and hopefully inspire you with some ideas how to stick handle your way through them. I use the term stick handle because I'm Canadian and we're hockey mad up here. A lot of people around the world say to me, "What on earth do you mean by stick handle?" It means hockey stick. And it's especially on the minds of people where I live in Vancouver, because we're just right now heading towards the NHL finals pretty soon, hopefully. So that's what's on our mind these days. But anyway, that's what it's all about, how to navigate your way through difficult setups. In Module 7, the first of 3 on a similar theme titled Scaling Up or Down, will show you how to apply the Fibonacci swing trader methodology for position trading. The next part of that is to show you how to apply it for day trading purposes, and then not surprisingly, the next adaptation down to the lowest level is scalping. Now, you don't have to use any of these if you don't want to, but what we're trying to do here is present you some options, okay, because there's no one trading style that's going to keep you busy 100% of the time. And being able to adapt to waxing and waning momentum and liquidity is a good thing to be able to do, because you can grab some additional opportunities as a result. Adapting your trading mindset to these different styles might not be anywhere near as difficult or confusing as you would otherwise assume. And that's because, again, we have the same basic methodology, we're just applying it on different groupings of time frames, which will give us both different size profit objectives and different time durations in the trade. And finally, what we'll do is try to pull it all together with 4 sample trades which apply these methods, and give you a complete rundown of some recent trades. Now, I could give you 20 examples. I could give you 50. I could provide weekly samples from now 5 years from now. But I think it's very important that you take away your learnings from this course and find the paper trades, the demo trades, and then when you're feeling comfortable with it all, the real-time trades in your live funded trading account. you need to do a little bit of work here as well. I can't just show you as many examples as you need to get comfortable. You need to do a little bit of homework yourself, and that's going to be just as important for you as anything. So we're going to show you certainly several illustrations. In Module 10, we're going to show you 4 sample trades, and we're going to leave it at that and ask that you, again, do your homework and find all of the other examples you need to learn this trading style. So that's what we have on tap for you here in version 2.0. 10 modules in total, and we'll probably run several hours in length once this is all said and done. As you know by now, Forex trading is an absolutely jargon-saturated business, and as much as it'd be nice to avoid jargon, I think it's impossible. We have our own language or terminology that we use, some of which is duplicative of trading in generally, some of which is specific to this methodology. So I'd just like to address some of those now, just a little bit of housekeeping up front. So when we refer to these terms later on in the presentation, and also hopefully in the daily update service, should you choose to join us for that, you'll know what we're talking about. Fibo, obviously short for Fibonacci, as in retracement or extension levels, all of which derive ultimately from the golden mean, and we'll talk about that in detail later on. The momentum matrix is just a concept. It's not an indicator, it's not a trading tool. It's just simply a top-down application of the triple screen methodology, grouping together consistent momentum readings on 3 consecutive time frames, all the way from the monthly chart right on down to the 5-minute chart. Various possibilities within that spectrum. P1 stands for take profit level number 1. We use 2 different profit target, which are both derived from Fibonacci-based levels. And so after a retracement, i.e. a rally in the downtrend or dip in the uptrend, we'll look to take part of the profit off the table when the market goes back to the current low or current high. Okay, and that is synonymous with what we call swing point B. P2 is the second profit target, and that is simply derived from the Fibonacci 27% extension level. SP stands for swing point. Swing points are very important, a very important component of this trading methodology, and a swing point is defined as a high preceded and followed by 2 lower highs on both sides, or in the case of a low, that would be a low preceded and followed by 2 lowers on both sides. So that means that it's a minimum of 5 candles. In fact, if you have 2 level highs or lows in the middle, it might be 6 candles. In a rare situation, you might see 3 middle candles all matching the exact same level. All of those are equally valid, but it's more likely you'll see 1 candle in the middle. So it's a 5 candle pattern, and it requires that after the expected high or low, you wait for 2 more candle closes thereafter. SPA is simply swing point A. In the case of a downtrend, that's the most recent swing point high. In the case of an uptrend, that's the most recent swing point low. SPB, of course, is just swing point B, which is the most recent swing point of opposite polarity to A. So if A is a low, B is a high, you would encounter that in an uptrending market. Okay, if A is a high and B is a low, of course you're in a downtrending market. SPC is in some respects the most important of the 3 in our 3-point retracement paradigm. Swing point C marks the end of the counter trend retracement after the market has moved off of swing point B. Swing point C, once it's complete, represents the ideal entry point. Of course, the trick is it's not possible to determine with certainty until after the fact, sometimes well after the fact, where swing point C exactly occurred. Okay, there's an aspect of uncertainty in that, and we just try to cobble together our analytics as best we can to try and identify the retracement terminus there. STO or STO simply stands for Stochastics Indicator. Our default setting here is 933. And finally, triple screen, as we already mentioned, is simply concurrent bullish or bearish momentum readings on each of 3 consecutive time frames. There might be the odd little bit of jargon in addition to this list popping up here and there, but for the most part, that represents the sum total of our course-specific trading terminology. We said a little earlier in this module that any good trading methodology, whether it's this one, which we hope you will enjoy, or something else, should be scalable. Another attribute of good trading methods is that you should be able to describe them pretty briefly. They shouldn't be long, drawn-out, convoluted, overly sophisticated things. You should be able to put it on a single piece of paper. So let's try to do that right here. Fibonacci swing trader in 10 seconds or less. What we do, again, is find a pair that shows strong momentum readings, whether bullish or bearish, across 3 sequential time frames. And being that our default is swing trading, that means we start with the weekly, daily, and 4-hour charts. If we come up empty-handed, looking for readings across multiple candidate pairs, then we might need to do something else. But if we can scan the market using screening tools that are available to us to find those pairs which demonstrate that characteristic, we'll focus our attention there. So we use the triple screen as a scanning or screening tool. It gives us momentum. That momentum tells us what kind of retracement setup we should look for. Speaking of which, the Fibonacci retracement will always be outlined by 3 major swing points, and they are always swing point patterns, virtually without fail. Again, highs, where the middle high is preceded and followed by 2 lower highs on both sides, lows preceded and followed by 2 higher lows on both sides. So swing point A will be a swing point. B will be a swing point. C will be a swing point. Almost guaranteed, almost every time. And those swing points we label A, B, and C will outline a Fibonacci retracement from start to finish. And again, what we're doing here is trying to accurately measure and assess a dip in the uptrend or rally in the downtrend. We look to buy those dips, we look to sell those rallies. Then we strive to get as close as possible into the end of the retracement, positioning ourselves accordingly, and simply ride the trade to the last higher low, which again will be labeled swing point B in our chart, and then the first available Fibonacci extension beyond, which again is fairly conservative. Sometimes the market will go well beyond. Sometimes it will stop exactly right there. The 27% extension level is sometimes uncannily precise. Other times the market might not make it quite that far, and it'll turn over on us and head back in the direction from whence it came. Those are all scenarios, again, you will encounter. And it is hard to predict ahead of time with certainty which of those scenarios will pan out. But just being aware of how the move can end is very important to how you manage the trade. So that's all we're trying to do. Buy the dips, sell the rallies, measured by Fibonacci retracements, split our position in 2, take some of the money off the table as price retakes the old high in the uptrend or old low in the downtrend, and then take the rest off at the first Fibonacci extension level. Of course, all of this is an absolutely gross simplification. We'll cover all elements off in greater detail, but that is really the gist of it right there. I'd like to take another brief respite from all those PowerPoint slides and flip into chart mode one more time for this module. And what we're going to show you here is just a very simple facsimile of a multi-monitor display. So instead of 4 separate monitors, which you can use if you like, but you don't have to, instead of that, we're just showing you 4 time frames scaled together on one display. And again, the 3 that comprise the so-called triple screen for swing trading purposes are the weekly, daily, and 4-hour charts. So I've got all 3 of those here: weekly in the top left corner, daily in the top right, 4-hour in the bottom left corner. Now I've added in here one of the available execution charts. Our primary execution chart is the hourly chart. But as I'm going to demonstrate for you here, sometimes you'll need to drill down even lower to a 15-minute time frame. And there's an outside possibility from time to time you may wish to drill down even lower than that, the 5-minute chart. But those are strictly optional. Okay, and we're just going to do, again, basically a 10-second summary of what we're looking for. And the beauty of this approach, and believe me, I've studied intensively many trading systems and styles over a long period of time. The beauty for me of this approach is that it combines simplicity with effectiveness. Okay, our very simple method for confirming momentum of the market is easily detectable in a very visual style. Of course, there's other things we can do to supplement that, looking at basic market structure. We're looking for a progression of lower lows and highs for a downtrend, which we can monitor with swing points, and vice versa for an uptrend. So this is not, I repeat, not an indicator-driven system, but we can use indicators intelligently here to help us find markets that are really moving somewhere with some sense of urgency. So it's simple and effective. So again, what we're looking for is just those instances of where stochastics 933 is lighting up red, i.e. below the 50% line, or green, all together at the same time. Okay, so we're looking for where stochastics momentum cycles line up across multiple time frames. Even that is no guarantee of a good trade. Even with a Fibonacci retracement, it's no guarantee of a good trade. Even if we line up other forms of support and resistance, it's no guarantee of a good trade. And the reason why it's not is because there is no such thing as a guarantee of a good trade. There's always risk. That's why we practice prudent money management, stops management, the whole 9 yards. But I believe if you give this approach a try, you'll be probably surprised just how effective it is, given how simple it is. Okay, because the more complicated we make our trading system, the more easily we're confused by it, and the less confidence we have in the trade, the less likelihood we're going to take a winning trade. Okay, so what I'm looking for, just as a basic screen, again, is those instances of where momentum is lining up the same way at the same time. So really, starting with the weekly chart in the top left corner here, I can see that really any time after the close, going all the way back to the week of December 28th, 2010, okay, stochastics went briefly bullish on us above the 50 line, painting in green, but then on the weekly close for the week of December 28th, it crossed back down and through the 50 line, flipping from green to red, bullish to bearish. And that little sort of flip up and down really reflected a larger wave structure here in the weekly chart, like so. And we, of course, we could do a Fibonacci measurement. Let's do that, in fact, just for interest's sake. Okay. Our jargon specifies a swing point A in a downtrend that's a high in the background right here for the week of September 1st, I would reckon. Then here's our swing point B, a temporary low in the downtrend. Price retraces to where? Exactly the 38% Fibonacci retracement, and then continues on its merry way down from there. So this crossover for the last week of December actually suggests a downtrend continuation underway already on the weekly chart. And you can see that's exactly what unfolded. But we're just, for now, just looking for that bearish reading. So we've got one on the weekly chart any time this year, right up until June. We've had 6 months of bearish readings on the weekly chart. Okay, but again, that doesn't tell us anything in isolation. It tells us that if we can find bearish readings on the daily and 4-hour charts concurrently from time to time, we can look for a trade. Look for a trade, not necessarily take a trade. So there's our weekly. Okay, now when we look at the daily chart, let's actually focus on a more recent time frame, not going all the way back to January, but rather the last month to complete here, which was the month of April. I'm recording this in late May. And you can see all the way through April, we had a bearish reading here on the daily chart as well. Stochastics had crossed down and through the 50 line on a close, going all the way back to the close of this bar here, March 21st, right there. and that did a pretty good job forewarning us of a significant down move. In this case from, well, it actually would be from the high of the next bar, March 22nd, at price quote of 11.98 here on the USD Mexican pair, 11.98 down to 11.48. Okay, relatively, that's a pretty significant move. Okay, so that's what we've got there. We've got a bearish momentum reading. And again, let's not just make it too simplistic. With this momentum, what we're trying to do is look for evidence of lower lows and at the same time lower highs. There's one, there's one, there's one. So you get the drift. Down, up to a lower high, down again, up to another lower high, so on and so forth. And our momentum reading is consistent with that all the way through. So anytime during the month of April we have bearish momentum readings on both the weekly and daily charts. So all that remains is to find those instances where it lines up that way on the 4-hour chart. Okay, so here's the month of April, and as is typical of the lower time frames, sometimes it goes up, sometimes it goes down. In this case, with bearish momentum on both the daily and weekly charts, we would tend to read situations like that, green above the 50 line, as counter trend indicators, right? So anytime we get a rally in the downtrend, stochastics is more likely to pop above 50 and give us one of these false readings here. False as in you wouldn't want to be bullish. It's just telling you there's a retracement and we're looking to sell that eventually. So let's look at a situation towards the end of the month where we have first a bullish crossover right there, April 18th, and then a bearish continuation crossover right there, confirmed by 12 p.m. April 19th. Okay, so it's not quite, yeah, it is actually that bar. 8 a.m. GMT, April 19th. All of our chart timestamps here are based on GMT. So that means anywhere from that open onwards, 12 p.m. GMT on the 19th, we have the bearish triple screen, bearish momentum readings on each of the 4-hour, daily, and weekly charts. So then what we want to do is to both find a setup and then also drill down and find an execution point with it. Okay, now we already have actually a swing point high in the immediate background right here. So we do our homework. We say there's a counter trend high with a rejection wick for 12 p.m. on the 18th. Okay, then we trace back to the last swing point low, which started the counter trend retracement, and then we go back further like so. And what we'll end up doing is labeling those A, B, and C. Whoops. There we go. So there's swing point A, it's a high. There's swing point B in the downtrend, it's a low. And there is swing point C, which is not a question mark, but red. I just paint those in red just to really draw your attention to them. Those are the most important swing points that we're working with. Okay, so there's our Fibonacci Fibonacci retracement rather, that lines up with our bearish momentum reading, and then of course we just attach those lines like so. Now this actually turned out to be quite a deep retracement. It went, I'm guessing, all the way up to 88.6%, almost. And this is sort of getting ahead of ourselves a little bit. The way we use these Fibo retracements is that we have a minimum acceptable level of 23.6%. Okay, in other words, a retracement has to go at least that far before we even consider taking action. And it can't go any further than 88.6%. That's kind of our cutoff there, because it means basically it's likely at that point the market is going back to the last high. And if it breaks it, then this is not a retracement. It's actually a reversal of some kind. Okay, swing point A is always our so-called kill level. In other words, if price breaks that level, something else is going on. But anyway, there's our setup. It's a Fibonacci retracement setup, and I would try to do other things, find other layers of support resistance. Resistance in this case, I have one right there, an old high in the background. And hopefully there are some pivots there as well. Oh, there's another high in the background. I almost missed that. Very important we catch all of them, old highs and lows. Okay, try and find some pivots in there. So again, what we're trying to do is find a very clear confluence of resistance. And with that rejection wick forming subsequently a swing point, which was confirmable by right here, midnight GMT on the 19th. That's a swing high, a high preceded followed by two lower highs in the Fibonacci target zone. Followed by this bearish crossover, it all becomes more likely that we're into downtrend continuation mode. So then we're looking for targets, first of all, down here, the Fibonacci 0% level, and that's where we take half the profit off the table. This is very conservative. You could certainly be more aggressive, but you do so on your own hook, because I don't want to be responsible for any results other than our conservative approach here. So we take part of a profit off at 0, part off at the 27% extension, and then if the market just keeps on going and going and going, well, we look for our next setup. Okay, we're trying to book profit intelligently here. Okay, so then what we do is, again, as of 12 p.m. GMT on the 19th, we're going to drill down to the hourly chart, 12 p.m. or after on the 19th. Drill down to the hourly chart. Now, as it turns out, stochastics had already given us a bearish crossover in the background well ahead of time. It did so on the close for 7 a.m. So 5 hours ahead of that triple screen reading, the hourly chart was already bearish, and it remained bearish for several days. And again, we see how these Fibonacci retracements are fractal in the sense that their form and function can be repeated on different time frames concurrently. This is an entirely different retracement that we're looking at here, which we can label small a, small a, to differentiate it from the other retracement that we just looked at. Small a, small b, small c. And you can see this particular Fibonacci retracement took us spot on to the 50% level right here. And then we had a swing point high, and then price went back to the old low, back to the 27% level, but in respect of the higher level Fibonacci retracement of the 4-hour chart, kept going and going and going. Okay, so we will only use this for an execution, but the problem here is we don't get, after 12 p.m. on the 19th, we don't get another stochastics crossover down and through here, not till quite a bit later. So what you have to be prepared to do from time to time is, if you can't find it on the hourly chart, you might need to pull out your 15-minute chart like so, even though this is not a core member of our chart lineup, if you will. But what we're looking for here are fractal crossovers or fractal retracements. Okay, again, we're looking for anywhere on or after 12 p.m. on the 19th of April. And so when we get the 15-minute chart first giving us a counter trend rally marked by a counter trend bullish reading on stochastics and then crossing down and through, that's where we look to take action. And so the earliest we could do that was, we got a little bit of a blip right here. This is around about 3:30 p.m. GMT. And it's so important that you work with not just the indicator, but the indicator lineup in conjunction with these Fibonacci retracements. Trust me, they happen on all time frames at all times. The only thing that differs is the size and scope. So here's one. Let's blow this up so you can really see it clearly. We had a high right there on the 15-minute bar for 12:45 a.m. GMT, April 19th. Price came down from that level, which we would label A, fractal A, down to here. The low for April 19th at 2:15 p.m. GMT, and then price goes to where? Wouldn't you know it? Just right about the 50% Fibo right here. And in doing so, this little very low level pullback here, stochastics first goes up, and then it reflects the continuation by coming back down. So it's on the close here, which happened April 19th at 4:15 p.m. GMT. The first candle opened thereafter. Sorry, that's 4:15 where we can go short. Okay, the 15-minute cross back down, and we are short there. The price sort of went sideways on us for a while, but certainly didn't trigger the stop. And in fact, in proper perspective here, you can see what happened in the aftermath. A really nicely timed entry point, lining up with that triple screen bearish reading, and taking us on down to the targets, which we would still look to the 4-hour chart for further down. So I hope that starts to give you a sense for what we're trying to accomplish here with our trading method. Triple screen momentum, Fibonacci retracements with a confluence of support resistance, using lower level entry triggers where stochastics reflects a counter trend pullback and then tells us the continuation moves underway, and that's exactly where we get in. So that's just a really quick high level summary of the trading method that I'd like to show you in the remaining modules. I close Module 1 here with a reminder, a very important one, and that is, even though we're all excited about the opportunity that Forex offers us, and it's plentiful, there's always risk. And you need to understand what those risks are. You need to understand how to manage them, how to protect yourself from them. And I would say to you, just as a more practical take on this long-winded bit of legalese here, practically speaking, you should not risk 1 red cent of real money in a funded trading account until you have taken as much time as you need to digest these course materials, understand them inside out, practice them in a demo account, paper trade and demo trade, until you have established for yourself a track record of success, which means that you quite likely could replicate those results over longer periods of time with a live funded trading account. You will not feel comfortable trading real money with real risk attached to it unless you've done your homework and done your practice. Trading currencies is just like learning a musical instrument or any other skill-based undertaking, and the reality is that takes many hundreds of hours. So please keep that in mind. We're going to do our very best here to give you a trading system that you can use quickly, but quickly is all relative. We don't mean next week or the week after. You should regard your learning journey with Forex as likely to take months, if not years. But hopefully, we'll address your learning curve effectively here and get you through it as quickly as possible. Please take a moment to read this statement and take its contents to heart, and we'll see you in Module 2.